welcome back to the channel. If you guys have ever been curious about how to buy a stock, what a stock is, how to get involved in the stock market at all, this video is for you. Before we get into it, some of y'all probably have noticed a little bit of a difference in my appearance with my hair being cut. You'll also quickly realize that I shot some of the videos in this series out of order. And so my hair will be growing like a chia pet, up and down, up and down. So just wanted to clear that up before we get into it. In any case, my name is Nathan Mohan. I used to advise companies on how to allocate their finances, but quickly realized that people did not have as good of a grasp on their personal finances as I once thought. And so I've shifted to making videos on that. With that being said, let's get into it. Okay, so when you go into the stock market, I think there's a bit of a misconception of exactly what you're purchasing and what you're buying. So when you purchase stock of a company, what that means is you are purchasing a piece of ownership for that company. Said differently, if I buy, say for example, Google stock, I am buying tiniest sliver of Google's ownership. I become one of the owners of Google, which means I am entitled to their profits and to any sort of growth that that company sees in its value, which you can see in its stock price. Now, you are buying such a small portion of the company that you will get to vote on decisions that owners would normally get the vote on. For example, if there's any sort of shifts in terms of acquisition or Google's going to get acquired, which again, highly likely, but if that's going to happen, you get voting privileges in those types of instances. Now, the beauty of going into the stock market is it's actually really simple to go and buy stocks. The reason why you go and buy stocks, as a reminder, is because the goal is when you buy that stock, you hope that it goes up and up and up in value. That is the main way that people make money. That growth in value is called capital gain. Now, there is a different way to make profits in stocks, which is something known as a dividend. When you see someone say there's a dividend on a stock, what that means is they are paying out a portion of their profits directly to the owners. Again, since if we are a shareholder, we become an owner. If Google pays out a dividend, we get partial access to that profit, partial access to that dividend. And we actually see that money come in. It'll be taxed, but it'll come in and come into our bank account. Now, with that being said, I wanted this to be an introduction to how to buy your first stock. So let me pull out my phone real quick and we will go into basically how to set up a brokerage account and then how to just go and buy your first stock, and a couple of metrics and strategies to look at while purchasing stocks. Buying stocks and playing stocks is actually much easier than most people think it is, mainly because the best strategy is probably the easiest one. So with that being said, I'll pull up my phone and we'll get into it. All right, so to go and purchase a stock, what you need to do is first download / make an account with a brokerage. A brokerage is a company or a firm that helps people buy and sell stocks. Usually what this entails is they find a bunch of people who are willing to buy stocks and they find a bunch of people who are willing to sell stocks and they match them together. So you are buying stocks from someone who owns it and you're selling stocks to someone who wants it. So let me pull up the app here and then we can go into it. First, I'll show a bit of a sign up protocol and how the sign up works. So we'll start out first with Robinhood. I have not made an account here yet, and so we'll just quickly zoom ahead to where I'm actually just making the account. And for now, we've gotten past some of the points here where you'll see like a username, a password, really because I don't want you guys to see exactly what I'm doing here. Then you'll see first name, last name. So we've gotten past all the username ID. Now it's asking for my first name and last name, which I already put in for the time being. Now, as I continue on the docket, it's going to ask me for some identity verification. This is pretty important for stock market type of activities, mainly because stock market activities are taxed. And so they need to know some of your personal details in order to come and message you. Let me put in my phone number here so that it has some of those details to help verify my identity. Ask it to send me a text, they'll shoot me a text, and then I will, as soon as that pops up, put that text through, which it just came through. We get through, we verify the phone number, it's gonna ask for my birthday, it took me a while to spell, and then some of my address and things like that. So for these, you guys will quickly notice that I am blurring some of the screen out. For obvious reasons. But anyway, we'll continue on. It'll ask you for citizenship. It'll ask you for your SSN, all these types of things. And so after you do all that, you'll eventually get to an account creation screen, and you'll be in a good spot post that. After that, you'll be able to log into your Robinhood account and start investing. With that being said, I just wanted to show you guys the Robinhood app in order to show how to make a brokerage account. But to buy our first stock, let me actually hop into a different account here in Schwab. And so for Schwab, I'm going to log into my account here, and then we'll get into the actual brokerage. And so what I want to show you guys while we're here is basically, like I was saying before, you could buy a portion of a company or a portion of a stock. And so most of these apps and brokerages look very similar, which is you can basically go to the trading window and then just look up a company's stock and begin to trade it. And so you can either look up a company name or a symbol. In this case, we were talking about Google earlier. Google is owned technically by a company called Alphabet, which is a parent company. And so a parent company, as you guys know, is a company which is you could call it a master company or a overarching company for a series of subsidiaries. In either case, you can see a couple of statistics on my screen here. So we have the bid, which is basically if I am looking to buy a stock, this is the highest amount someone is willing to buy the stock at, or the highest price. We have the ask, which is the lowest amount that someone is willing to sell the stock at. And you can see the lowest amount someone's willing to sell the stock at will always be higher than the highest amount someone's willing to buy it. And the reason for that is the brokerage actually makes money every time this trade is executed. So that gap of 4 cents that's currently on my screen, the brokerage actually takes that money. And because they do it on so many different shares, they're actually taking advantage of that overall spread. Or alternatively, there's a market maker in the background, which again, kind of similar motion. From there, there's a couple of actions here. So do we want to buy? Do we want to sell? Do we want to short sell? Short selling is basically you are making money when the stock goes down in value. Alternatively, another way you can say it is you are borrowing a stock and then selling that stock to someone else. And so at the end of the day, you have to give back the stock that you borrowed. And so that's the reason why you're basically selling it immediately. The cash comes in, you have to buy it back at some point, right? And so the stock goes down in value. Say you bought the stock for $300 today, trading for $250, and you only did it for 1 share. You sold the stock for $300, but you owe that guy a stock at some point. You buy the stock back at $250, you pocket $50. So for us, if we want to buy a share, I'll put buy, we'll just buy 1. And then you can see a bunch of different order types here. The first order on this list is market. Market basically means that you're going to purchase the security at the current ask price. The second option is limit. Limit allows you to set a price at which you will buy the security at. You can buy the security for under that price, but it'll never go over that price for your purchase. The third here is stop. The way stop works is if your stop price is traded at, then you will immediately place a market order. The fourth option here is stop limit. The way a stop limit order works is it's kind of similar to both a stop and limit combination. If the stock trades at your stop price, you will then place a limit order at a specified limit price. The last option here is trailing stop. Trailing stop is the most interesting of the options. For trailing stop, depending on if you're looking to buy or sell a security, you will basically peg a stop order at a percentage or dollar differential to either the bid or ask price. We are looking to buy a security, so for us, we will set a peg based on the ask price. Say, for example, I set a 10% trailing stop. The way this works is it'll take the current ask price and add 10% to it. If you see the stock price, or ask, I should say, dip, then our trailing stop will also track at that 10% differential. However, if the ask price goes up, you'll see it go up until the point where our stop price is hit, and then we'll end up at a normal stop order, which becomes a market order. Now, you guys will realize as I click on different order types, the timing option below ends up changing. And so when I use limit and I look through the different timings that are available, you can see the top one here is day only. What day only means is the order has to be placed during normal market hours, which are 9:30 to 4 p.m. Eastern Standard Time. If it's not placed, then the order will be canceled. Day plus extended means the order must be placed at the normal market time or during extended hours. Extended hours differ from stock exchange to stock exchange. The New York Stock Exchange and NASDAQ are 2 examples of stock exchanges that you might have heard of. But for the New York Stock Exchange, extended hours last from 7 to 9:30 a.m. and on the PM side go from 4 p.m. to 8 p.m. all on Eastern Standard Time. Good till canceled means the order will be active for 365 days unless it's canceled. and it will only be active during standard trading times. Good till cancel plus extended means that the order will be active for 365 days and can be traded during extended hours. Extended hours AM we went through, but as a reminder for the New York Stock Exchange, it is from 7 to 9:30 a.m. Eastern. Extended hours PM for the New York Stock Exchange is 4 to 8 p.m. Eastern. Immediate or cancel means the order must be filled immediately or it'll be canceled. And finally, fill or kill. This means the entire quantity of the order must be filled or the order will be canceled. Now, the last thing I wanted to talk about was investment strategy. Thankfully, the best investing strategy tends to be the most simple. Now, this investing strategy even beats stock picking professionals. About 90% of stock picking professionals lost to this investing strategy over the course of 10 years. What is this amazing strategy, you might ask? Well, it is simply just buying an index fund. An index fund is probably something you've heard of, like the S&P 500 or the NASDAQ. It is simply a collection of companies. Taking the S&P 500 as an example, the S&P 500 is a collection of the 500 largest companies listed on US stock exchanges. The way the S&P 500 is constructed is it takes each of those 500 companies and creates a pool of investment such that the underlying fund is composed of a market weighting of each of those securities. An easier way to think about it is if you look at the largest company in the US and that size of that company is 10% of the total market capitalization of the top 500 companies, or said differently, if you look at the value and combine all the companies, the top 500 of them, and the company that you're looking at is 10% of that total, then 10% of the S&P 500 will be that stock. Now, what this means is if those companies grow or shrink in the S&P 500, to say that company that's worth 10% of it grows or shrinks, that's how the S&P 500 gains value or loses it. Now, the way to get access to the S&P 500 is primarily through ETFs. The ETFs that I like to use are VOO. This is a Vanguard ETF that allows you to invest in the S&P 500, and it's pretty cheap. The expense ratio is super reasonable. The other one that I like to use is IVV, which again is an iShares ETF. And again, the reason I like it is the expense ratio is super reasonable. All an expense ratio is the cost for you to put money into that ETF, aka what the ETF provider takes from your profits in order to fund their operations. And Vanguard and iShares both have pretty reasonable expense ratios. With that being said, y'all, that was a quick intro into the stock market. We will likely go a little bit more in depth at some future point. But again, the real strategy to investing in the stock market is going to be investing money into an index. The other thing I would want to note is that everything we talked about today was very US centric. And so there are other indexes that are more global that you might want to invest money into. And a couple of those include the Nikkei out of Japan, FTSE out of the UK, the Hang Seng Index out of Hong Kong. And so there's a lot of other worldwide indexes to look at, especially this year, actually. They would have been great to invest into. And so with that, thank y'all for tuning in. If you have any questions, drop them out in the comments, and I'd love to engage, love to respond. All right, we'll see y'all in the next video.